Right now, as we speak, Intel Corp is trading at exactly $39.52. That is a massive intraday surge of plus $2.70, locking in a gain of 7.35% for the session so far. If you're watching the charts on your Fidelity mobile app or tracking the tape on Interactive Brokers, you are seeing a volume spike that is absolutely defying the typical quiet trading we usually expect on a shortened holiday week. The tape is moving fast and the bid-ask spread is tightening, signaling aggressive accumulation rather than just short covering. Most people looking at this ticker today see a legacy chipmaker trying to claw its way back to relevance. The expectation, the lazy narrative you will hear on cable news, is that this 7% pop is just a dead cat bounce or a sympathy move with the broader semiconductor index. That is the surface-level take. The reality is far more uncomfortable and far more profitable for those paying attention. This price action is not about sympathy. It is about a fundamental repricing of risk following the disclosure of the Norway Sovereign Wealth Fund's massive $1.5 billion entry and the aggressive posturing regarding the TSMC trade secret lawsuit. The market is suddenly realizing that Intel has transitioned from a distressed asset into a government-backed fortress, and the smart money is front-running the realization that the worst is officially behind us. To understand why this move to $39 matters, you have to look at who is buying. Retail investors on the Robinhood app have largely been chasing Nvidia stock and SoFi stocks for the last 2 years, ignoring Intel as dead money. But look at the order flow today. The block trades coming through on Interactive Brokers trading platforms are institutional in size. We are talking about hundreds of thousands of shares per clip. This is not day traders flipping pennies. This is capital allocation from funds that see the United States government's 9.9% equity stake not as a bailout, but as a floor. When the government effectively becomes a co-owner to ensure national security, the downside risk profile changes mathematically. The expectation was that Intel would bleed cash until 2027. The reality, confirmed by today's price action, is that the balance sheet has been fortified to a point where bankruptcy is off the table, and now the stock is being repriced as a call option on American manufacturing sovereignty. Let's look closer at the intraday mechanics. The stock opened at $37.40, already gapping up from the previous close, and it didn't look back. It smashed through the $38 resistance level within the first hour of trading. If you are using Schwab Intelligent Portfolios or managing your own individual brokerage account, you might have noticed the Relative Strength Index (RSI) on the hourly chart pushing into overbought territory, yet the selling pressure is non-existent. Usually when a stock like Intel hits an RSI of 70 intraday, you see profit-taking. Today, you're seeing absorption. Every time a seller steps in at $39, a buyer steps up at $39.10. This tells us that the overhang of disgruntled shareholders from the $20 lows of early 2025 has finally cleared out. The people holding the stock now are not bag holders looking to break even. They are new entrants targeting $50 or $60. Consider the psychological warfare happening here. For months, the narrative was that Intel was losing the AI war to Nvidia stock and the CPU war to AMD. That was the expectation. But the reality emerging today is that the market is forward-looking. The market is sniffing out the success of the 18A node before the first commercial chips even hit the shelves in volume. The news that TSMC is suing an ex-executive who joined Intel is paradoxically bullish. Think about it. You do not sue a competitor who is irrelevant. You sue a competitor who is becoming a threat. The market interprets this legal aggression as validation that Intel's Foundry division is actually closing the gap, making the investment help you might get from a standard financial advisor seem lagging compared to what the price action is telling us right now. Now, pause for a second. Comment below how many shares of Intel you currently hold, or if you sold during the panic of 2024. I want to see if the sentiment in the comments matches the bullish aggression we are seeing on the tape today. Expanding on the broader sector context, this move is happening while Apple stock and other tech giants are relatively flat or showing only modest gains. This relative strength is the most important signal a trader can look for. When a stock ignores the general market lethargy and rips 7% higher on its own specific catalysts, it is a sign of a change in character. For a long time, Intel was the stock that would drop 5% when the market dropped 1%. Now, it is rising 7% while the market is up barely 0.5%. That is a momentum shift that SoFi active investing algorithms and high-frequency traders pick up on immediately, accelerating the move. We also need to talk about the retail versus institutional dynamic in online investing. While the big volume is institutional, we are seeing a shift in retail sentiment on forums and social channels. The Robinhood crypto crowd, which usually looks for high beta volatility, is starting to look at Intel's volatility as an opportunity. It's rare to see a large-cap legacy name move like a crypto asset, but Intel's beta has significantly increased. This attracts a new class of trader, the momentum surfer. These traders don't care about price-to-earnings ratios or dividend yields, they care about liquidity and range. Intel giving them a $2 daily range is like blood in the water. This creates a feedback loop. Institutions buy the fundamental thesis, government floor plus Foundry turnaround, and the traders buy the momentum, pushing the price to $39.52 and potentially testing the psychological $40 barrier before the close. Let's step back and look at the company itself, because if you are just joining the Intel story, the context is vital. Intel is not just a chip designer, it's an integrated device manufacturer, or IDM. That means they design the chips and they build the factories, or fabs, that make them. For years, this was their Achilles heel, because their manufacturing fell behind TSMC. However, under the massive restructuring plan, often referred to as IDM 2.0, they have effectively split the company internally. There is the product side, which designs chips like the new Panther Lake processors, and the foundry side, which manufactures chips for Intel and potentially for external clients. This separation is key. The market is starting to value the foundry business as a standalone asset, similar to how investors view distinct entities in Fidelity mutual funds. If the foundry business succeeds, it becomes a strategic asset for the entire Western world, distinct from the volatility of consumer electronics. The recent earnings reports have been a mixed but improving bag, which is exactly what value investors love. They don't want perfection. Perfection is priced in. They want less bad. Intel's client computing group has shown resilience with the rebound in the PC market, driven by the corporate refresh cycle, as companies upgrade to Windows 11 and AI-capable PCs. This provides the cash flow, cash bridge needed to support the capital-intensive foundry build-out. The data center numbers are still fighting a brutal war against AMD, but even there, the bleeding has stemmed. The expectation was a complete collapse of market share. The reality is a stabilization. And in the stock market, stabilization after a collapse is often a buy signal. Furthermore, we have to discuss the government put. With the U.S. government holding that 9.9% equity stake, the downside is theoretically capped. This is something you rarely see discussed in standard investment help articles. It forces short sellers to cover. If you're shorting Intel at $30, you are betting against the U.S. Treasury. That is a trade very few hedge funds have the stomach to hold for long, especially when the stock starts ripping past key moving averages. This short covering is adding fuel to the fire we are seeing today at $39.52. But let's look at the risks, because self-investing requires an honest look at the bear case. The execution risk remains enormous. Intel has to deliver on 5 process nodes in 4 years. They are currently claiming victory on 18A, but yield rates, the number of usable chips per wafer, are the only metric that matters, and those numbers are closely guarded secrets. If 18A yields are low, the profitability of the foundry business evaporates. Additionally, the interactive broker's fees for borrowing stock to short might be low now, but if Intel misses a deadline, the shorts will pile back in. The battle with NVIDIA stock in the AI accelerator space is another massive hill to climb. Intel's Gaudi chips are a value alternative, but NVIDIA owns the premium market. Intel doesn't need to beat NVIDIA, they just need to pick up the crumbs, but even that is a challenge. But the future outlook is where the disparity between expectation and reality is widest. The expectation is that Intel will never regain its crown. The reality is that the geopolitical landscape has shifted in Intel's favor. The world is fragmenting. Supply chains are becoming nationalized. In a world where global trade is frictionless, TSMC wins. In a world of tariffs, trade wars, and national security anxiety, the world we live in now, Intel wins. This macro tailwind is invisible on a quarterly spreadsheet, but massive over a 5-year timeline. It's the reason why Fidelity Wealth Management advisors are likely telling clients to hold through the volatility. The chart at 39.52 is also telling us something about the technicals. We are approaching the $42.50 level, which was a massive breakdown point in the past. If Intel can reclaim $42, the technical vacuum above that level could see the stock run to $50